We've been bullish on gold since February of 2016, when gold came up off its December 2015 low at
hmm
1,050. At 1140, we said, okay, major upturn. We'd been bearish from 2012 through 15, by the way. But we had annual momentum breakout. And when you looked at a price chart back then, you just another staircase low, and you barely turned up off of it. But when you looked at momentum, you saw something different. Anyway, but the point is that that long-term metric of measuring the trend direction of gold, for example, or silver, has not broken down since then. It's continued to rise in layers, but nothing technically has indicated that that bull trend that began 10 years ago
hmm
is over. And then now you're reaching the phase, though, in the bull trend where you're no longer doing the arm wrestling layered advance, which has, bored the heck out of gold investors for the last 10 years and frustrated silver investors, because you go up and then you have this 1 year wide range, and then you go up again and you have a correction, and it's arduous. Those spread relationships, meaning it's a relative valuation chart of the ounce of gold divided into the S&P 500 price. And we went back to 2013 and on that chart, and you could see that basically over the last 11 years, gold has wandered sideways in value to the S&P, ups and downs and ups and downs, but basically contained. So you could call it a par performer, meaning, depends on when you bought gold, you're doing better than the S&P, sometimes worse, but basically sideways in performance over that 11 years, which very few investors had acknowledged, but it was a fact. Anyway, that chart had a very clear ceiling on it. And you could draw for like 4 pivotal highs that bumped this line, okay? And late last year, they closed above it. Monthly closing was October, November. And since then, what happened is gold has surged in relative performance to the S&P, well up out of that base. But the net price of gold has also gone quite vertical, okay? Same thing happened with silver shortly. I think it was the same month, actually, where it had a basing type relative performance to the S&P. A little bit more declining than gold had been over the last 11 years in terms of its valuation to the S&P. And it broke out and it exploded. Okay. So the spread chart was a technical metric above and beyond our normal analysis. Normally what we're looking at is the momentum of price,
hmm
where we plot a price chart on the top where that's what everybody sees on their screen, And below it, we plot a momentum oscillator, which takes that price chart and oscillates it versus certain moving averages, and in this case, long-term averages. And that's already been in a bull market. We know, silver and gold been going up for quite a while. So the issue is, well, why did they suddenly go berserk? Well, the reason was that signal occurred, and indicating an asset class flow out of the stock market and into them. Now, you haven't seen the stock market weaken yet. It's just sort of fumbled around for about 6 months, really. But
Right.
you've seen some kind of money flow suddenly said, okay, we're moving out of this neutral pattern. We're going into monetary metals. So somebody's waking up. And
Yeah.
that caused that push effect.
Behind these moves lies more than price charts. It's momentum. Oscillators tracking long-term trends showed gold and silver already in a slow bull market. But the breakout revealed something different. Funds were quietly rotating out of stocks and into precious metals. While the S&P and Nasdaq remained strong, subtle flows hinted at growing investor concern about equities. These flows amplified price moves, triggering a vertical surge in gold and silver. This wasn't the end of a bull market, it was acceleration. Analysts who ignored long-term metrics misread these signals, missing the early stages of a fundamental monetary shift.
We've been bullish on gold since February of 2016, when gold came up off its December 2015 low at
hmm
1,050. At 1140, we said, okay, major upturn. We'd been bearish from 2012 through 15, by the way. But we had annual momentum breakout. And when you looked at a price chart back then, you just another staircase low, and you barely turned up off of it. But when you looked at momentum, you saw something different. Anyway, but the point is that that long-term metric of measuring the trend direction of gold, for example, or silver, has not broken down since then. It's continued to rise in layers, but nothing technically has indicated that that bull trend that began 10 years ago is over. And then now you're reaching the phase, though, in the bull trend where you're no longer doing the arm wrestling layered advance, which has, bored the heck out of gold investors for the last 10 years and frustrated silver investors, because you go up and then you have this 1 year wide range, and then you go up again and you have a correction, and it's arduous. We reached the point late last year when the relative performance of monetary metals versus the US stock market said no more. We're now going to leave the earth compared to you. We're leaving you behind. And that's the point at which it's indicating at least an initial shift by normal portfolio managers, fund managers, that are saying, hey, Morgan Stanley said 60-40 is no longer good. It's now 60%, 20% bonds, 20% gold. And that was a huge intellectual admission on their part that the old reality was wrong. Okay. And that UST bonds are not, the other alternative that the stock market, instead gold is. I disagree with their weighting, but at least it was an admission. Well, some money has started to flow, and you can measure it. You can see it.
Institutional recognition of gold's rising relevance has begun to shake traditional portfolio thinking. Morgan Stanley's admission that 60-40 allocations may no longer suffice reflects a broader reevaluation of risk. Bonds are faltering, the US dollar weakening, and investors are exploring gold and silver as alternatives. This shift is subtle but measurable. Money is beginning to flow into a sector historically considered small and niche. The result? Vertical price advances that defy conventional bull market logic. Historical comparisons like the 2011 silver surge or 1980 gold moves offer perspective, but the current monetary environment suggests we may be witnessing the early stage of an unprecedented bull cycle.
No, there's times when gold should be at the front, okay? And we're at that point now where it's outperforming even the bubble US stock market, which is one of the strongest stock markets since 2009. US stock market's been among the strongest. China's not a bubble. It's only about double where it was in 2009, but we've gone up. S&P's gone up 11, 12-fold. NASDAQ 100's gone up 20-plus-fold since 2009. So measuring gold against them it's a harsh measure, because it's a strong market, strong stock market, and yet it's beating it, indicating somebody punched a hole in that dam and the water's starting to flow out. Okay. It's going into money. Okay, so that's just begun, though. That's the point, is that just began. So people who are talking about, well, it's almost got to be over because it's vertical, silver, gold, vertical.
Yeah.
On arithmetic charts it is. But they're wrong. The game really just began, where the real water flow into the monetary metals has only just been signaled. So the more accelerated price phase, where that money flows into what really is a fairly small sector, especially the gold and silver miners.
Right, tiny, yeah.
There could be, a huge impact on the verticality of those markets.
Silver is entering a unique phase, historically undervalued relative to gold. While both metals are advancing, silver's breakout from decades-long ranges hints at extraordinary upside. Spread analysis measuring silver versus gold shows potential for gains far beyond historical norms. Previous surges in 1980 and 2011 doubled or tripled prices in months, but silver's current valuation suggests the next move could dwarf those events. Logarithmic analysis indicates swing objectives exceeding $500 per ounce in extreme scenarios. Even modest gains imply rapid acceleration. Investors may face short-term corrections, but the underlying trend is a massive revaluation of silver, driven by both technical and monetary factors.
Our assessment on that: one, this is not a normal bull market. So using old standards of verticality and saying, well, in 1980, we had this surge, huge surge in the tail end of that move. In the last 5 months of that move, in fact, silver quadrupled. 5 months.
Yeah.
And already an aged bull trend. And in 2011, after going up for 10 years, silver in the last 7 months jump from 20 to 50, double and a half. All of a sudden, boom, boom, faster than it ever had a pace during the entire bull market.
Mm-hmm.
This is different, not simply because silver broke out above what I call idiot highs, the old $50 high
Yeah.
of the half century. Uh, it's because of other technical factors that we're looking at, and there's clear monetary factors underneath this stuff that are only just now engaging, like the dollar index, for example, which we got bearish a year ago at 104. It's now trading about 96. It's a modest drop. But we broke all the annual momentum uptrends of the dollar index going back to 2010.
Okay.
Price chart stopped on a trend line that any idiot with a ruler and a crayon could see, and they've been buying it there for 9 months. Now you're breaking below it. So that game is just beginning. In other words, a sharply weak dollar.
Yeah.
T-bonds are in dire straits. They're dancing on glass. The Fed is buying them, but they're not going up. That's another market that could, with a rough ballpark number, you drop 2 to 3 more points in the T-bond futures, and they're trading around just below 115 right now, 30-year bond futures. You drop down in much under 113, like in the 112s and 111s, you could have a panic in government debt, not in mortgages, but in government debt. Japan has already got it. If we start to show it, that rips everything apart in terms of stability assumptions, asset categories.
Yeah,
And at that
I
point,
agree. If we
Yep.
had a loss of confidence in the U.S.
well,
Treasury,
I think you're going to get it. And the question is it right now or is it in a month or two? And I could go for the month or two. I think you're going to get that downside, and in the T-bonds, which will upset the world and upset the stock market at that point. Right now, the T-bonds are so comatose. Well, the president of the Fed, New York Fed, Williams, around the time we had our last talk, made a press conference in November that said that the Fed is now going to, quote, start buying bonds. Okay. Ooh, okay. His reason was not to support the market, but to provide liquidity.
Several macro factors reinforce this momentum. The US dollar has weakened from 104 to 96, breaking long-term support levels. Treasury bonds are unstable, trading in a historically narrow range despite Federal Reserve support. Any failure to stabilize yields could trigger a crisis, pushing investors further into precious metals. Globally, other markets like Japan have already experienced debt stress. Rising geopolitical tensions, inflation uncertainty, and central bank interventions all add fuel. The convergence of weak bonds, a softening dollar, and investor caution makes gold and silver increasingly attractive. The stage is set for monetary metals to outperform traditional assets dramatically.
They've been buying since then, and that bond market has oozed lower and lower, and you can tell it's being supported because, like the last 2 months in T-bonds, and this is important because it'll impact gold and silver. They've been in the most narrow price range in T-bonds, where they can't seem to go any lower, but they can't seem to rally either. It's like a 1.5 range in T-bonds, not yield.
Yeah, they can't get the yields below 4. Yeah.
I've never seen the bond markets in decades have a narrow range that protracted, that narrow, going back years where it's behaved like that. So it's evident that they are in fact buying and supporting that market.
Yeah.
But it's not causing it to go up or yields to drop. That's a problem. And that could just begin, meaning if it doesn't succeed in holding it and we slip a couple more points, our technicals say you could get a downside panic in price, upside in yields. It could be off to the races before that happens. Our assessment of this move in silver in particular is that it's going to a new reality. I can give you umpteen long-term verbal reasons why, charts included. I think silver's going into several $100s, may even go as high as 500, and I think it will do it by summer this year. These accelerated moves in silver, even the ones that occurred in that compressed 50-year, half-century antiquity range that surged up to $50, They occurred in a couple quarters where silver went ballistic and reached the top of that range. We're no longer dealing with that range anymore. But some of the same technical metrics that signaled the onset of those orgies on the upside in silver, where it had already been going up for years and suddenly goes berserk, was a spread relationship between silver and gold. Silver is still vastly undervalued to gold. If you go back 50 years and look at the surges in price that occurred in silver, like 79 to 80, look what the spread of silver versus gold was then. In other words, divide an ounce of silver into an ounce of gold. Back then it was 6.5%. Okay, keep that in mind. Then in the 2010-11 final 7-month surge of that multi-year bull market, silver broke out versus gold on a spread chart now. You didn't see it looking at the price chart. Price was going up, both of them going up merrily, but that spread broke out and that announced verticality for silver that lasted a couple of quarters, just like the other one, 79 to 80. Silver went up double and a half in 7 months, but it was still confined in that 50-year range, which was sort of silly given the degradation in the money unit. If you factored where silver ought to be now versus 1980 high at 50, it probably should be $500. In fact, I think that's about right. And if you measured it against the 2011 peak when silver was 50, in that surge, again in the box, its spread was 3.1. Right now, silver is only 2.1% of the price of gold, so it's still cheap historically. We are arguing that not only has silver broken out of its range and likely to have an orgy on the upside that mostly gets done within a couple quarters, counting again from the November close last year. So December, January, we're only 2 months into this couple month thesis.
We are in the early chapters of a potentially historic bull market for precious metals. Short-term corrections are likely, mirroring patterns from 1980 and 2011, but these are part of a broader upward trajectory. Technical metrics, spread relationships, and macro signals all align, suggesting gold and silver could experience rapid vertical moves. Investors should prepare for volatility, but the underlying trend is clear. A reallocation of capital toward monetary metals is underway. The coming months may deliver dramatic gains, especially for silver, as historical undervaluation and accelerating flows create a perfect storm for unprecedented price action.
That the spread might just do what price did, namely take out the highs of the last 50 years. $50 silver, $50 silver, that's gone. Okay, fast. Why not challenge the relative performance highs because silver is still cheap? Why not challenge 3%? Why not challenge 6.5%? Price took out those highs. Silver's still cheap. Maybe its spread will also reach those levels. You do the math on what silver might continue gold up, what silver might be at 3% or 6% of an ongoing bull trend in gold. It takes you off the page.
Wow.
Another metric here. Now, pardon me for going too long here.
No, it's all good. It's all great.
If you look at an idiot price chart, arithmetic scale, go back to 75. You've got that range that was like from $4 lows to $50 highs. So, call it a $50 range or a $45 range. And if you see a price range like that and you break out, the orthodoxy of price analysis is to, take the thickness of the range and add it to the range. That's your swing objective. Well, we reached that about a week or so ago when we were in the 90s, mid-90s, 95 area. That matched the swing objective of the dimension of that range. And you found there was a lot of selling there. I don't know if you remember what it was. We had some pretty sharp hourly sell-offs in that range. We finally blew those guys out. So it's no longer an issue of, double the range. When you look at silver on a ratio scale chart, logarithmic, same period of time, go back to 75. The bottom of that range was $4 and you go to 50. Okay, well, that's like a tenfold move plus. So a geometrically or logarithmic scale, ratio scale. How much did silver go up? Tenfold from the bottom of the range to the top. You broke out of the range. The logarithmic swing objective of that same range on a ratio scale chart is $500. Because you break it out at 50, tenfold is 500. Don't laugh. Okay. Now, I'm not saying we've got to go to 500, But I am saying everything else we see says this will be one dramatic and extremely fast. And yes, the worry about a correction in the middle, that's highly likely. And what we're doing at MSA right now is trying to deal with that issue for our subscribers so that if they are itchy, or let's say they've got leverage positions and they've got call options, things that, they don't particularly want to have to suffer through a correction with. We're going to try to measure when and where that occurs. Our suspicion right now is, one, the factors that would define that. And by the way, corrections like this did occur in that 79 to 80 surge, where silver quadrupled in 5 months and doubled in half between September 2010 and April 2011 on the way to $50. There was a correction in each of those right in the middle of that clock, like a month 3, let's say, either side of that, where you had what you could call a correction. It was only 15% in each case, by the way.
Okay.
It was enough to cause people to think, that's the top. What happened on the other side of that was even more than what had happened in the first half of that couple quarter move.
Right.
So it's going to be interesting. I suspect you're going to get a trading type wiggle that all the doubters and the people using old metrics will say, there we go. We're going to have a major correction. You're not. I think you're going to have a wiggle, something that interrupts it for like a month. And then when you come out of that, that's when you get the next burst. That's our assessment.